Good afternoon and welcome to Markets Today. I'm your host, Mbithe Mwema. Today we are taking another look with regards to what is the outlook for the macroeconomy in the year 2020. For the last 2 weeks, we've been talking to different investment houses and getting their views on what they expect for this year. Today we are taking a slight tangent with regards to how we want to portray and deliver our message to you. What we are questioning is, be over and above the macroeconomic variable numbers that we are seeing flowing into the economy from the analytical desks, what does that mean for you as a business?
Institutional investors and also local corporates, for that matter, want to understand, whether Kenya will finally reduce its fiscal deficit, which has become a problem and a talking point for a few years now. So that's what we get asked a lot. But the institutional investors also focus a lot on what's the likelihood of Kenya getting an IMF precautionary program. It's not that we have a balance of payments problem like, say, Zambia, but they prefer the IMF anchor, as it will probably ensure fiscal credibility according to them. So that's what they're asking, is Kenya going to come to the market for another Eurobond? Because the new Ministry of Finance is talking about, shifting away from commercial and non-concessional to concessional debt. So these are some of the questions that everybody's asking, and of course everybody's worried about what the corporates, more specifically, whether external debt service will really mean a lot of volatility for the Kenyan shilling this year.
All right, let me take you back to the element of the fiscal position. And the fiscal position is really you're comparing government revenue vis-a-vis government expenditure.
Right.
What numbers are we looking at now?
So there was the budget policy statement it's a draft statement that was released yesterday, and the government's talking about that deficit, as you said, the difference between revenue and expenditure. That will be, they're talking about 6.3% of GDP, which is lower than the 7% outturn that we saw last year. But again, the reservations that we have are that the deficit number, the planned deficit number, could be lower on paper because the implied growth in revenue that they expect, which we don't agree with, is too ambitious. So that will bring down the planned deficit. But in reality, when you look at the fact that the consumer could take at least 6 to 7 months to pick up from some of the challenges that we will discuss as we go on, I think revenue collections are still going to fall short. Targets are too ambitious, and when you look at the budget policy statement, the government is still growing development expenditure, and nobody's saying that we don't need infrastructure, but we just need to think about priorities. We need to think about value for money. We need to think about whether it's needed now. Could we postpone it? Because if you think about it, the easiest way to consolidate public finances and improve investor sentiment, especially given that they're all focusing on the fiscal position, is by just postponing capital-intensive projects.
That's true. All right. I mean, it's very interesting when you're talking about the extent of the expenditure that the government wants to get into for this financial year that's coming up. But I want to take you back to the element of revenue and just see the relationship between the revenue generation, the prospects of the government of Kenya going for an IMF standby facility. There is a consequence of additional taxes, either for you at an individual level or for you as a business. Is that something that's sort of a risk factor when you're looking at revenue generation by the government and its consequence on you as a consumer of the government products or government services in this economy?
Yeah, I mean, it's a very good question. So obviously, if the government believes that they need the facility, especially if they want to improve sentiment, I think something that authorities have indicated to a lot of people that they would prefer to have that standby facility. But as you rightly mentioned, what are the conditions? I think the IMF seems to have gone a bit more lenient on the whole overvaluation of the shilling. But of course, on the fiscal side, they may believe that we need to increase taxes on basic commodities. From my side, I would fundamentally disagree with that at this point in time. I think the fact that we have a fiscal deficit that's persistently very high is not because consumers are not paying tax. It's because businesses are not thriving, and subsequently households are also suffering. So I think to come in with a wider tax just to bring down the deficit would prove to be counterproductive in my view, because it would just reduce taxation. The other thing, Bide, that's very important is also the fact that we need to ensure that when authorities are under pressure, or we need to acknowledge that when authorities are under pressure to collect taxes, there's a fine line between collecting more taxes being generated by a chicken and egg scenario where the economy is improving and people's pockets are getting deeper.
Yes.
But when you move towards extortion, when you move towards intimidation, when you move towards arbitrary assessment, something that a lot of companies are talking about today because there's pressure to collect taxes, that ultimately will keep revenue collections even lower than what you believe. So we saw this in Tanzania.
Yes,
when
we did.
The president came in 2015, 2016. Despite the rampant efforts to boost tax collection and crack down on tax evasion, the method of approach was actually one that was counterproductive and resulted in low revenue collections.
Lower revenues, and then there was also a spike of non-performing loans in the same economy.
Yes.
So I think what I'm trying to build up in all of this is not when we come to the figures of your outlook for the GDP growth, which I think our graphics team will put up. You have a good figure, and it's an upward trajectory with regards to the year-on-year growth rate. And yes, it's happening at a macro level, but so what? Because what you're telling me, what I'm hearing you say is, if I'm running a business, there is the incidence of additional taxes, some that I currently already have to book in my books today, but then there's the risk of actually having to bear a higher tax burden as a business owner.
Right.
So then how am I going to thrive in this year as a business owner or as a person who's investing in this economy?
So first things first, for what it's worth, in our report, we are expecting GDP growth to recover to 5.9% from our expectation of 5.6%.
Okay.
Of course, last year, in the early part of the year, there were delayed rains, or many said it's even a drought, but agricultural productivity suffered. And I'm not a fortune teller, but it looks like the rains are coming in quite good. It's always difficult to predict, but we are expecting agricultural productivity to pick up, but also from a base effect.
Yes.
Given that the third quarter print last year was so weak, there will be a positive base effect that will unwind and support growth statistically.
Okay.
And I think that's what you are getting at. What does 5.9 mean, even if it's so 6.5? And that's the issue we've had between the better part of 2016 all the way to, I'd argue, 2019, where growth inclusivity has lacked.
Okay, growth inclusivity is just lacking.
Yeah, so that's where the common man would say, which growth, where is it coming from, why don't I feel it? And that's where the layman would say, for example, you're talking about 6%, but I see auctions in the paper, I see foreclosures, I see all these things. So that happens when the private sector is not necessarily driving growth.
Okay.
And I think that's been the major challenge. And as I talked about in my presentation when you were there, the rate cap impact has suffocated the private sector by reducing cash flow, which was propagated by the fact that the government wasn't releasing payments. And the point that I try to make is that historically, when the government doesn't make payments, commercial banks would be happy to step in and provide that sort of bridge financing through some short-term working capital finance. But 2016, 2019 rate cap environment, it never happened. So it was a bit of a double whammy. So I think we need to ensure that the private sector becomes the dominant driver of growth for us to feel that growth and for growth to be inclusive. Because from what we've seen across the world, not just in sub-Saharan Africa, if you don't have inclusive growth, then it will never foster sustainable growth.
Exactly.
And I think that's the biggest challenge we have. I mean, Ethiopia is the best example, lauded for being the fastest growing economy in the world. We saw the political challenges that morphed there with all the demographics that we thought were favorable as economists, but
everybody
when you have
else.
when you don't have inclusive growth, it's
then
not
it catches up with you, because then it begins to instigate social reform, and you really don't want to go that way.
True.
But you brought up a very interesting point, probably a precursor to my subsequent questions. But the fact that now we have the rate cap repeal that has already been removed, and it sounds from your report that you actually expect this to be a core driver for this growth. Are there particular sectors that you think will be direct beneficiaries with regards to the banks extending credit to them?
So obviously there is a consensus that generally banks will be able to price risk and lend more. But I think also, just to evaluate that point, there's another school of thought, or people on the other side of the fence, that say that aggregate demand is still weak, NPL is still about 12% and sticky. So banks will be cautious before they assess asset quality and redistribute credit to the private sector. But the fact that we believe that there's still opportunities out there to lend. You know, think of it as a chicken and egg scenario.
Okay.
The more we lend, the better people do. You know, I think there will be a meaningful increase in credit, not just in 2020, but also in 2021. Of course, as you know, with the rate cap repeal, all loans have to be fixed at the CBR plus 4% contract.
Yes.
So generally speaking, there will be an incentive for commercial banks to book new loans on a risk-adjusted basis and, you know, price them at what they want. But in terms of the sectors, you know, of course, everybody is very quick to blame banks. But, you know, what I showed you guys that day at the presentation was that, you know, when there was a drought, obviously, in the rate cap environment, credit growth to the agriculture sector went down.
Okay.
When the SGR issues were becoming a lot more prominent, the transport sector went down in terms of what banks were lending to them. So I think we can't expect, you know, as a blanket, without thinking or being oblivious of economic conditions, that commercial banks are going to lend to every sector. Now, because we believe the weather is going to be good this year for tea production specifically, and of course source market demand from Pakistan and Egypt, which are big buyers of our tea, you know, those economic conditions are improving.
Exactly.
So we think, you know, there'll be better flow of credit there, and then of course we already saw consumer durables was getting more credit towards the latter part of 2019, and I think that trend will continue because, as you probably know, that the biggest hit during the rate cap environment were unfortunately the most vulnerable, and you know, the medium enterprises and the retail borrowers. Those
ones were not getting money, and there's also been a huge push, whether it's from His Excellency's sentiments with regards to the state of the nation. KEPSA also later in the year came up with a report with regards to access to credit and the lack of it with the MSME sector. So is that something that you're seeing as a possible trend in terms of people or banks or financial institutions beginning to give this micro and small micro enterprises money from the banking sector, but then maybe the touch points are agriculture, transport, consumer durables? Or do you think we'll get into a situation where the banks cannot figure out how to price risk and would prefer to actually lend to the larger corporates?
I think, I mean, obviously a difficult one to answer, but of course this will be very different from bank to bank in terms of the risk profile and the structure of the balance sheet. But I think there's it's one thing that I want to highlight is there's a banking charter from the central bank.
Banking charter from the central bank.
Which is helping us to embrace risk-based pricing, which is helping us to ensure that we are more transparent in how we price credit, meaning we have to, as a sector, move away from name lending. You know, it's not about you come in with a nice suit, wearing a nice cologne, and you know nothing about agriculture, but because I know you're going to get this loan.
Yes.
You know, as the governor of the central bank says, a chicken farmer deserves a loan for chicken farming.
Okay.
So I think
should I read the banking charter as a mwananchi? Should I actually go and download it and read it and at least get a sense of what rights I have before I walk into a bank?
I honestly think so.
Yeah?
I really do. I mean, I think that would not just put the banks on their toes, but would, you know, help you understand why, you know, the Central Bank of Kenya, and as you said, the executive is quite confident that this time it's going to be different. But, you know, one thing that's also important is that in the rate cap environment, which shows you the opportunities, in the rate cap environment, you know, the sort of Shylocks and the unregulated banking sector used to lend at 10-15% per month.
Yes, Jibran, that's exactly where I was going to, because I was going to ask you, and I really like this conversation because you're preempting my questions. On one end, yes, the banks might take some time to actually extend credit. But then on the other end, we have this Shylocks who are actually extending credit, and for them, they don't even, they only care about your willingness to pay back and your willingness to afford it.
True.
So you've said you can even pay 15% per month. But then the other elephant in the room in this whole conversation is you have the central bank who's sitting there and it's saying we're coming against and we are clamping down on predatory lending, which is this expensive lending.
Right.
Jibran, what happens?
You know, obviously it's unregulated lenders, so we can't really be proponents of it. But the thing that, you know, makes me think about this a lot more closely is the fact that you can lend to someone at 15%. They are grateful for that credit and they are paying you back on time. I mean, if you look at some of the data, you know, the default rates was not as high as one would have thought. So the point I'm trying to make is that, you know, we generally tend to shy away from what we perceive to be risky lending.
Okay.
But what this scenario has shown us is that they may have a business model that's doing well, because if you're borrowing at close to 80% in an annual
in a year,
then of course you're doing something correctly. So I think it's an eye opener, but of course it's an unregulated sector, and it could get out of hand and reckless if it's not regulated. So I can see where the central bank is coming from, but of course I really hope that commercial banks as a whole, post the rate cap repeal, convince the common man and everybody else, the skeptics out there, that they are able to justify what they price credit at.
Justify the price, but what you're saying is we need money flowing into the private sector in one way or the other for us to be able to feel the inclusive growth. Jibran, we'll take a quick break and we will be back shortly. However, we do want you to engage with us on our Twitter page. You can either engage with me on @Mbitha on Twitter or at Metropole TV. What are your thoughts? Are you running a business? I mean, we keep throwing these numbers out there, 5.9% GDP growth. Will your revenues grow at that level? Will your bottom line grow at that level? Will your investments grow at that level? What kind of information would you like us to be able to give you so that we can help you make a better decision? As always, we'll take a quick break. We'll be back shortly. But remember, in studio, we are joined by Mr. Jibran Qureishi, who is the regional head of the economics desk at Stanbic Bank. We hope to see your comments and see you in a few.